What's up, my fellow financial warriors, and welcome back to Boss Economics World. The only channel on the internet that gives you the unfiltered, no BS truth behind the numbers they're trying to sell you. Today, we're dialing our time machine forward to September 23, 2025. And what a time to be alive. The coffee is still overpriced, politicians are still promising fiscal responsibility while swiping the national credit card, and the Federal Reserve, the Federal Reserve is still playing its favorite game, laser-focused on inflation. The latest memo from the ivory tower comes from Cleveland Fed President Beth Hammack. She stepped up to the podium and dropped what the mainstream media is calling a hawkish warning. She says she's laser-focused on inflation, and that the Fed should be very cautious about cutting rates further, lest they overheat the economy. Now, for those of you who just woke up from a 4-year coma, let me catch you up. It's late 2025. Inflation, as measured by the Fed's preferred core PCE metric, has been stubbornly clinging to life above the sacred 2% target for over 4 years. We've seen it all: the transitory fantasy of 2021, the panic hiking of 2022, the disinflation hope of 2023, the sticky plateau of 2024, and now, the "are we there yet" nightmare of 2025. The Fed finally gave in to Wall Street's desperate pleas and political pressure, delivering a quarter-point cut in December 2024, and another one just last week. And now, Hammack is hitting the brakes. She's worried. She says the labor market is still in pretty good shape and that policy is only very mildly restrictive. Let's stop right there. Let's unpack this official speak, because this isn't just a statement. This is a coded message that reveals the entire, terrifying contradiction at the heart of the American economy. This is the point. Now, let's connect the dots and see the whole surface. Hammack's most explosive comment wasn't about overheating. It was this little gem: policy is only very mildly restrictive. Let that sink in. The current Fed funds rate, after last week's cut, sits at 5%. For over a year, we were told that rates in the 5.25 to 5.50% range were a sledgehammer to the economy. We were promised that this restrictive policy would crush demand, spike unemployment, and send inflation back to the 2% promised land. And now, a high-ranking Fed official, in a moment of stunning honesty, is telling us this sledgehammer is actually more like a foam noodle. This single comment rips the lid off the biggest, most uncomfortable debate in modern economics: the mystery of the neutral rate, or R-star. For the pros watching, you know what I'm talking about. For everyone else, R-star is the theoretical interest rate that neither stimulates nor slows down the economy. It's the Goldilocks rate. For the past decade, the Fed operated under the assumption that R-star was incredibly low, maybe around 2.5%. So, a 5% Fed funds rate should have been economic napalm. It should have frozen the housing market, cratered business investment, and sent unemployment soaring. But it didn't. Why? Because Hammack just tacitly admitted that the old models are broken. The neutral rate isn't 2.5% anymore. With a structural baseline of higher government spending, deglobalization, and a rewired labor market, the new R-star might be 3.5%, 4%, or even higher. If the true neutral rate is, say, 4%, then a 5% Fed funds rate isn't a sledgehammer. It's like putting a speed governor on a Ferrari that limits it to 150 miles per hour instead of 200. You're still going dangerously fast. This is the intellectual crisis at the Federal. They've been flying a 747 in a hurricane using a map from the 1990s. Hammack is the one pilot in the cockpit looking out the window and screaming, "That's not a cloud, that's a mountain." Hammack's comments expose a deep, bitter rift within the FOMC. This isn't your grandfather's hawks versus doves debate. This is a fundamental disagreement about the very nature of the 2025 economy. On one side, you have the soft landing dreamers. This is likely the camp Chairman Powell is leaning towards. They are haunted by the fear of over-tightening and causing a deep recession. They look at the slowing job growth down from a blistering 300K a month to a more sustainable, but still positive, 160K, and they see a mission accomplished. They see the headline unemployment rate at a historically low 4.1% and declare victory. They are under immense pressure from the White House and Capitol Hill to keep the party going, to cut rates and juice the economy. Their mantra is, "We've done enough. Let's not break something." They believe inflation will gracefully drift back to 2% on its own. On the other side, you have the inflation realists, the Hammack Brigade. They look at the same data and see a completely different picture. The robust labor market, they don't just see the 4.1% unemployment rate. They see the Atlanta Fed wage growth tracker, which, despite a year of restrictive policy, is still flashing a fiery 5.1%. That's not compatible with 2% inflation. They see that layoffs remain near historic lows. Companies aren't shedding workers because they know how hard it will be to rehire them in this new, structurally tighter labor market. The sticky inflation, they're not looking at the price of used cars, which has come down. They're looking at the supercore services inflation, the stickiest of the sticky, which is still running hot at 4.5%. This is your car insurance, your hospital bills, your rent. This is inflation that has become embedded in the system. The latest CPI report for August 2025 showed that while goods prices were flat, services ex-housing shot up at an annualized rate of 5.5%. That's not disinflation, that's a warning signal. Hammack's camp believes that cutting rates now is like a doctor giving a slice of cheesecake to a diabetic patient whose blood sugar has only just stabilized at a high level. Sure, the patient feels better for a moment, but you're risking a full-blown crisis down the road. They believe the last mile of getting inflation from today's stubborn 3.2% core PCE back to 2% will be the hardest, and it requires keeping policy genuinely restrictive, not mildly so. This is where we zoom out from the Fed's internal squabbles to the global tectonic shifts they refuse to fully acknowledge. The 2% inflation target isn't a law of physics. It was a product of a very specific 30-year period of economic history that is now, definitively, over. What defined that era? I call it the 3 pillars of disinflation. 1. Hyperglobalization, a fire hose of cheap goods from China and other emerging markets, suppressing the price of everything you could buy at Walmart. 2. Cheap and abundant energy, stable geopolitics and technological advances kept energy costs relatively low and predictable. 3. A global labor arbitrage, a massive, accessible pool of cheap global labor that put a permanent cap on domestic wage growth. Now, let's look at the world in late 2025. Every single one of those pillars has crumbled. The era of putting all our eggs in the cheapest basket is over. We're in a new age of friendshoring, onshoring, and national security-driven industrial policy. Do you think building a semiconductor fab in Arizona, paying American union wages, costs the same as building one in Taiwan? The CHIPS Act and the Inflation Reduction Act are, by their very nature, inflationary. They are redirecting capital to less efficient, but politically safer, places. A recent study by the Peterson Institute for International Economics estimated that these reshoring initiatives are adding a persistent 0.4% to baseline annual inflation. It's the price of security, and it's not going away. The multi-trillion-dollar global push for green energy is massively inflationary in the short to medium term. It requires unprecedented amounts of copper, lithium, and other commodities, driving up their prices. Simultaneously, underinvestment in traditional fossil fuels, combined with a world map that looks more fractured and volatile than ever, means a permanent geopolitical risk premium is now baked into the price of oil and natural gas. Brent crude, which was expected to be back in the $60s, has found a new, stubborn floor around $90 a barrel. The government's spending addiction, this is the elephant in the room. While the Fed has been trying to tap the brakes, Congress has been flooring the accelerator. The U.S. national debt is now north of $38 trillion. The budget deficit for fiscal year 2025 is projected to be 6.5% of GDP, a level historically seen only during major wars or recessions. We are running a wartime deficit in peacetime. This firehose of government spending is directly fueling demand, working at cross purposes with the federal. The Fed is essentially trying to mop up the floor while the government has the sprinklers on full blast. This phenomenon, known as fiscal dominance, means the central bank becomes a hostage to government spending. If they raise rates too high, the interest cost on the national debt becomes catastrophic, creating a sovereign debt crisis. So, their hands are tied. They have to tolerate a higher level of inflation to keep the system solvent. When you add these 3 structural forces together, the conclusion is inescapable. The natural, underlying inflation rate of the global economy is no longer 2%. It's probably closer to 3% or 3.5%. The Fed's laser focus on 2% is like trying to force a river to flow uphill. They can build a dam and hold it back for a while, but the pressure will build until something breaks. This brings us to the most cynical part of Hammack's statement, her concern for the robust labor market and overheating. Let me ask you, does the economy feel overheated to you? For the top 10%, absolutely. The S&P 500 is flirting with 6,000, not because corporate earnings are exploding, but because Wall Street is high on the drug of anticipated rate cuts. Asset holders have been made whole and then some. For them, the economy is fantastic. But for the bottom 50%? The working families? Their experience is one of stagflation light. Their wages, even with the 5.1% growth, are barely keeping pace with the real cost of living increases over the past 4 years. The cost of a basket of groceries is up 30% from 2021 levels. Auto insurance premiums are up 40%. The average 30-year mortgage rate, even after the Fed's cuts, is still a painful 6.25%, locking an entire generation out of homeownership. The robust labor market is a statistical aggregate that papers over immense cracks. We have seen a surge in multiple job holders, not as a sign of ambition, but of desperation. A single 40-hour-a-week job no longer pays the bills. A recent Bank of America Institute report showed that credit card delinquency rates for lower-income households are now higher than they were in 2019. So when a Fed official says they are worried about overheating, what they are really saying is they are worried about wages for working people rising too fast, threatening corporate profit margins. They are worried that the labor market might finally tilt in favor of workers for the first time in 40 years. And they are willing to risk a recession and job losses for millions to prevent that from happening, all in service of an archaic 2% target that the structural economy can no longer support. So what's the play here? What does this all mean for you? Beth Hammack is telling the truth, but not the whole truth. She is right to be terrified of inflation's ghost. It's a monster that has not been slain. The forces of deglobalization, greenflation, and fiscal dominance are hurricane-force tailwinds for inflation that will last for the next decade. But the Fed is trapped. They are caught between a political system that demands cuts and a new economic reality that demands higher for longer rates. They are caught between an asset-owning class that has benefited immensely and a working class that has been running in place for 4 years. My prediction? The dreamers will win in the short term. The pressure is too great. The Fed will talk like Hammack but act like Powell. They will likely deliver another precautionary cut in December, citing some manufactured weakness in a jobs report. They will declare victory on inflation, even as it hovers at 3%, and hope nobody notices. This will juice the stock market for another 6 months, but it will be a Pyrrhic victory. They will be setting the stage for the next, more vicious, wave of inflation in 2026 or 2027. By refusing to adapt to the new reality of a 3% world, they are guaranteeing more volatility, more uncertainty, and ultimately, more pain down the road. The era of easy money and stable prices is over. Beth Hammack just gave us the eulogy. The question is anyone in charge actually listening? That's all for today. Stay sharp, question the narrative, and protect your assets. This is Boss Economics World, signing off.